Welcome back, investors. Jake here. Thankfully, yesterday Amazon posted a good quarter, saving the S&P 500 for today. But I still cannot get over this one-day drop that Facebook experienced yesterday. And this was the largest market cap drop for an individual stock in US history. Facebook, or Meta, lost $230 billion in market cap valuation. Mark Zuckerberg's net worth dropped by $30 billion in one day. So potentially this pivot for the company to the metaverse isn't going so smoothly. We'll see if he gets the last laugh. Additionally, Amazon, their quarter, let me just break it down, the highlights here. Investors are very happy with the growth of their web services division. This has a very high profit margin. I think it grew by 40%. It's still relatively small compared to their overall business, where they basically still lose money selling stuff on Amazon.com, but there is profit growth thanks to AWS. Additionally, their earnings per share is a bit wonky. They earned 27.75 and the consensus was $3.54. This is because they made a huge profit on investing in Rivian early on, and then it got a really good IPO valuation in November or December. Another thing that has investors really happy is Amazon is increasing the price of their Prime membership for Prime Video, Prime Music, Prime 2-day delivery, and they're increasing this from $12.99 to $14.99 a month, or $119 to $139 a year. And this is pure profit. This is basically the subscription model that Costco follows, where they get you hooked on their service. They then can increase the annual membership fee. This is basically pure profit for the company. So investors are pretty happy. And what I just want to quickly highlight with these two examples of Facebook dropping 25% in a day and Amazon going up 14% in a day, this shouldn't happen with mega caps. The fact that Amazon's market capitalization is $1.5 trillion. Facebook's had to have been close to $900 billion. These stocks should not be moving double digits in a day. And what is happening here is everybody is paying attention to the mega caps. Everybody is trading these stocks, and they're willing to pay any price on the way up, and they're willing to sell at any price on the way down, because once again, people are expecting a very volatile and tumultuous year this year, because market prices and market valuations are changing so rapidly due to Fed policy and larger macro trends. So in this video, let's talk about my Schwab accounts, because I want to de-leverage or de-risk my portfolio a little bit over the next week as I basically regroup and try and figure out my personal strategy for the rest of this year. So I started this account on January 1st with about 60,000, and I'm down 20%, or about 12 grand. And we can blame HCI, we can blame that SPY debit spread, and we can blame Facebook. Don't trade on earnings. That's the lesson that I need to learn. So in this video, the position that I want to be talking about is in Apple. And currently I have 3 call contracts on Apple with a strike of 150. I bought these back in October when the share price of Apple was below 150. Apple's current share price is 172, and these are long calls because the expiration isn't until January of 2023. My cost basis was $5,596, and the current market value is $10,305. I'm up 84%. Now I could just do the simplest thing and sell to close these today for $10,305, get my $4,000 or $5,000 in profit. But what I actually think is going to happen with Apple is it's going to be trading sideways for another couple months, range bound between these two values of 180 and 160. So in the most recent sell-off, it got as low as 160. A couple months ago, it got as high as 180. I don't think Apple is going to be making new time highs. I was hoping it could get to 190 or 200 potentially, but When you look at Apple's valuations based on the most recent quarter, which was a good quarter, it just wasn't good enough, I think, in this environment with investors to justify all-time new highs for the stock. But their price to free cash flow is 31. It's an all-time high. Price to sales is currently 8.14, an all-time high. PDE is currently 31. Not an all-time high, but almost double where Apple's been traditionally valued in the past. So is Apple going to hit all-time new highs? And I don't think it actually is. And when you do a longer view technical analysis of Apple, this is actually very interesting. But it's actually been locked in a consistent uptrend since June of 2019. It briefly dipped below the line during the COVID crash, but it got back above it. And you can see that on this slope or this trajectory, it gets ahead of itself, trades sideways until the line catches up, shoots up, trades sideways, shoots up, trades sideways. So we're currently in this sideways consolidation range, once again between 180 and we could argue maybe we could bring this up to be about 160 here. So do I see this getting to all-time highs anytime soon? And I don't. So what I want to do in the meantime is figure out how can I make money on my long calls while they're just basically holding as Apple's share price trades sideways. If this slope continues, the share price might not touch it until April or May. So what I'm going to do for you guys in this video is show you how to create a risk-free debit spread on a long call position that is now deep in the money. So let's go back to my Schwab account, and we're going to be selling 3 call contracts against the 3 call contracts that I bought that are in the money. And we're going to make this simple and just do an expiration date that is currently the same as the one that I bought the calls on. Another quick thing I want to point out about the technicals is that for the stochastics, the %K just crossed below the %D. Doesn't mean Apple's going to sell off, but it is in the overbought range, and I think from a technical perspective, it also doesn't support Apple breaking out anytime soon. So back to this risk-free debit spread, my goal is to sell 3 call contracts against the 3 call contracts that are in the money by my cost basis to pull out my original investment. That way, it's literally impossible for me to lose the money that I originally put in to Apple a couple months ago. So let's go to the option chain and set this up, execute the trade, and then just talk about what are the possibilities. So here is the option chain for Apple, and for expiration dates, once again, for the 3 calls that I'm going to sell, it's just going to be the same expiration date as the 3 calls that I bought. If I wanted to sell calls against my long calls with a shorter expiration date, a couple weeks or a month, basically I'd be doing the poor man's covered call technique, but I want to simplify all this, so we're just going to go with the same expiration date and click continue. So you can see with the strike of 175, I can currently get $2,000 given to me. This is money that's going to be going in my account today. Let's actually pull that up real quick. So on my account page, you'll see cash and cash invested. It's a negative 252. I'm going to receive premium. I'm going to receive money today from selling these calls against the calls that I have deep in the money. So we're going to go straight at the money, guys, because I don't see Apple going much higher, or if it does, I think it'll pull back at some point in the next 2 months. So let's go ahead and sell 3 calls with a strike of 175 and try and get about $6,000. So here's the trade page. Once again, we are selling to open 3 call contracts for a strike of 175, expiration date January 20th, 2023. We're looking to get paid today $6,000. Let's go ahead and execute this. And there we have it, guys. I just created a risk-free debit spread, and I pulled out my initial investment in these 3 call contracts for Apple. So my cash and cash invested is 5,789 because I was negative 252. And what happened here is I created a risk-free debit spread. So my cost basis was 5,596 for these Apple contracts. And then I got it back by selling calls against these contracts worth about $6,000. So I've capped my upside if Apple all of a sudden unexpectedly breaks out, but I've also secured my downside. Let's talk about what is possible when you've created a risk-free debit spread. So let's pretend that Apple's share price completely plummets and it goes below 150 a share. If it goes below 150 a share, then these contracts, the ones that I bought, expire worthless by January 20th. The value goes to zero. But the calls that I sold against them also go to zero. So the initial investment that I put in, this 6,000 that I got out today, I can't lose it. It is impossible now for me to lose money on this trade from my initial investments. If Apple goes to zero, the company goes bankrupt and gets delisted, I've already pulled out the $6,000 that I initially pulled in. I cannot lose any of my original investment on this trade. However, what if Apple skyrockets and breaks out and goes above 175? It never gets below 175 again for me to get out from underneath these obligations of the calls that I sold. Well, in that scenario, the contracts that are in the money, everything is in the money. The call contracts above 150 are slowly gaining intrinsic value as time eats away at the extrinsic value. And the difference between the share price and the strike by expiration, dollar for dollar, is how much the contract's going to be worth. But also by expiration, what I owe somebody else on the calls that I sold equals what I'm gaining on the calls that I bought. So I've capped my upside, and you can look at the difference of the strikes, which is $25. Multiply that by, let's see here, multiply that by 100? Yes, $25 in share price difference, multiply it by 100 shares per contract equals 2,500, but I have 3 of these. The max profit I can make by expiration if I completely screwed this up and Apple's share price goes way above 175 is $25 multiplied by 100 multiplied by 3. So the max profit I can still make on this trade is $7,500, which is pretty good. The market value currently was $10,417. But I don't think it's ever going to get to that point, guys, because I'm pretty confident that Apple is not going to reach all-time new highs in the next couple months. And I'm pretty confident that I can buy to close these contracts that I sold at some point for a profit in the next 2 or 3 months. So on news of the Fed raising interest rates or maybe volatility because of options contracts in the third Friday of the month, Apple's share price is probably going to make it back to 160 before it hits this slope line and takes off. So if Apple's share price currently at 172 can get down to 165 or 160, the value of these calls that I sold will decrease and I can buy to close them for less money, maybe $3,000. So I sold open to get $6,000 from the 3 contracts. If Apple's share price drifts down to 160 or 165, I can then buy to close these back while holding on to the calls that I bought. This is confusing, guys. Yeah, maybe I should have some more visuals to explain what's going on here. Okay, I just hit you with a lot of information there. We're going to be doing something similar next week for Berkshire Hathaway, as I've currently netted 152 profit, and I definitely want to lock in some gains of at least my cost basis to protect myself on the downside. Additionally, if the market has more panic sell-offs, I just need more cash in order to redeploy for other trades. Okay guys, if you enjoyed this video, give me a thumbs up so the algorithm knows it's good. Any questions or comments, please let me know. Till the next video, take care.